One of the classical warning signs at a dividend growth company is if one sees a spike in inventory. And one oftentimes sees a spike in inventory when sales growth is sluggish or down because there's less sales. The company produced all this inventory and they can't sell it, but so they portray it as an asset on the balance sheet. Again, Kimberly-Clark passes the test with flying colors. Hey everyone, this is Ian. I am back with another video about dividend growth investing. I am so excited today because this is the third video in my series about analyzing dividend paying stocks in great detail. I am using the stock Kimberly-Clark as the example in this series, in this video. This is a stock that I personally own. I've owned it for many years. Lately I've been averaging in. I've been buying more, a little bit at a time, because I believe that the stock is a good value right now for my personal portfolio. And so the first video in this series was all about just the basic screens, how a stock goes from being a concept to making it to my watch list. The second video was a very important one. It was the one about analyzing income statements. And this is probably the most important analysis that I do when I am analyzing dividend paying stocks. Today's video is the third, and this video is about analyzing balance sheets. And I do them in this order for a reason. After I've digested the income statement, it is very advantageous to jump into the balance sheet. That is a perfect time because the balance sheet, a lot of the things that manifest in the balance sheet support the income statement or support ideas that start being formulated when analyzing the income statement. So at a high level, worth noting, these analyses that I do, they are very specific to dividend investing. I invest for dividends, for companies that pay dividends, increasing streams of dividends over time, also known as cash flow or passive income. And I invest in these companies because one day I'm going to use these dividends to literally pay all of my bills and to pay for everything. And so one that is a dividend investor may look at a balance sheet, an income statement, a little bit differently than a different type of investor. So that's just worth noting. Also, thank you for hanging in there. I know these videos have been taking a little bit of time to produce. These videos are a little more technical, so it takes a little bit more time on my end. But I'm working on them. I'm excited to have the third one today, and I have more on the way. And when I'm done with these videos, I'm at the end of the series. I am going to share with everyone my personal guide. I'm going to share this strategy, an Excel file, a Word file as well, that breaks down exactly how I analyze stocks. And I'm going to share that with all of you as a free gift in hopes that others may find value from the very materials that I personally use when I'm going through these analyses and that I use to document my own dividend stock analysis. So stay tuned for that. It will be presented in a video. I will share in the video how one can receive that gift. It will be coming this year in 2018. So without further ado, I'm going to jump into the balance sheet today for Kimberly-Clark. As I always do, I've got my notebook and I jotted down quite a few notes. So at a high level, what is a balance sheet? Well, the income statement, just as a refresher, is very important. It's a snapshot into the actual sales and profits a company is driving. It's really a representation of the purpose of the company. Why is a company in business? Obviously, they have a greater purpose, but also it's to primarily drive profit. And so income statement shows the revenue, the costs, and the profit that is driven, the net margins, net profit. And what we noticed in Kimberly-Clark as a refresher is sales growth has been drying up. Margin expansion, especially operating margins, net margins, has been good. So they've been managing the sales growth really, the decline in sales growth really well. But that being said, at some point they need to resume the revenue sales growth again. And so in a company, look, when I invest in companies, I'm in them for many, many decades. And so all companies, great companies, will go through cycles. Kimberly-Clark is going through a cycle. There's a reason there's a buying opportunity, that the stock is at reasonable levels. It's not at an all-time high. And it appears now it's come back a little bit, but I'm still averaging in, by the way. But all companies go through cycles, and we know the reason for this cycle by looking at the income statements because of the sales growth slowing down. Thankfully, they've done a great job managing the margins, though, through these times, and dividend growth. Now, with declining sales volume, there are definitely some red flags that can show up on the balance sheet. So what is a balance sheet? At a high level, a balance sheet is a representation of really the company's bank statement almost. It's how much money do they have in the bank, how much money do they owe. It's a financial snapshot. It's a snapshot of assets and liabilities. Assets, by the way, are things that the company owns, like material things like cash, inventory, buildings. Liabilities are money that the company owes to others, like short-term debt, long-term debt. So it's literally a financial statement, a financial snapshot. And what's great about a balance sheet is it shows you how financially responsible is a company. How financially responsible is the CFO, the finance team, the CEO, the company at running the operations? Is it a tight operation, or are they a little more lax with the finances? I've seen companies before where even with great revenue growth, great income statement, sometimes they're a little lax with the balance sheet, with the assets and liabilities. And so I love assets and liabilities, the balance sheet, because it really shows a different element. Putting aside sales growth, putting aside market reception, like maybe it's not a great market for a company's products at a certain point in time. Maybe the sales growth has slowed a little bit. It should come back, but it's slowed. Putting all of that aside, during some more difficult times, is the company good at managing its finances? That's what builds character, in my opinion. That's what shows character. It shows responsibility. And so that's why I love the balance sheet. So anyways, jumping into it, top of the balance sheet always starts with assets. And so before we get into this, actually, where do I find this information? I find it on the quarterly reports and the annual reports. I just go to the company's website, I go to their investor relations, and I look for what's called the 10Qs and the 10Ks. Typically, for balance sheet items, I don't look at it as closely on a quarterly basis as I do income statements, because it just typically is harder to see trends. I like to look at it year by year. So for this particular video, what I did for Kimberly-Clark is I looked at the 10Ks, the annual reports, and I looked at them for 2013 through 16. I also looked a little bit further back as well, but I didn't document it yet in my notes. So I always start with the assets. And what are some of the things I like to look at assets, and what things are not as important? Well, first thing is current assets. When it comes to assets, there are two types of assets. There's a current asset, and then there's other assets. Other assets, typically, in my opinion, are not very valuable, at least in my opinion, because if a company were just to go under, I look at the worst case. What can the company come up with now to pay the bills? Usually it's a current asset. It's things like cash or cash equivalents, things like that. And so I like to look at current assets. Anyways, there are a few things in current assets that are important. First and foremost is cash. Does the company have some cash? Does it have a cash buffer? Has it been going up? Has it been going down? Well, with Kimberly-Clark, it's been pretty flat, a little bit down. In the end of 2016, the cash was $923 million. At the end of 2013, it was $1,054 million. Now, with a company that's very predictable, it's very stable, it's not as important to have a huge cash buffer. The reason there's usually not a huge cash buffer with those types of companies is these companies usually pay out dividends, like Kimberly-Clark. And so having the cash in this general range, seeing it pretty flat, I'm okay with that. It passes the test. When would it not pass the test? If I saw that they had very little cash, like next to nothing, or cash just took a sudden drop. It just dropped off a cliff. I like to see things pretty steady on cash, and if they can get by in this range of plus or minus $1 billion in cash, having a market cap of about $41.9 billion, that's fine. That's fine with me. So they passed the test there. Accounts receivable. I love this one. This one is so important. So accounts receivable, it basically means that it's money that will be coming into the company. They've already sold these goods, but the people they sold them to have not paid up yet. And the bills are forthcoming. They're forthcoming in the short term. They're receivables. And so, in my opinion, accounts receivable is not really an asset. It's portrayed as an asset, and it is to an extent, but here's where the risk comes. Let's say, okay, sales growth is down at Kimberly-Clark. Let's say, hypothetically, accounts receivable were way up. That would be a total red flag. What that typically means is the payment terms with others have been made more lax. They've been renegotiated. The other people have been giving more favorable payment terms. That's not good, because money is not money until it's in the bank. If it's a receivable, in my opinion, it's not yet an asset. It's portrayed as an asset on balance sheets. I don't like to see hefty accounts receivable. I don't like to see accounts receivable spiking. Thankfully, with Kimberly-Clark, when I look at the end of 2016, receivables are $2.176 billion. End of 2013, they're $2.545 billion. And they've actually steadily kind of climbed down over those years. So what I love about Kimberly-Clark is, yes, sales growth have been slowing. They've made up for it by increasing their margins. At some point, the sales growth has to go again, and I think it will. But thank goodness they've not been compensating for the lack of sales growth through more favorable payment terms with others. And thank goodness I don't see a huge spike in accounts receivable. And it may go up and down over time, but as long as it's in the range, I don't see a tremendous spike. That's really important. And based on my analysis here, looking at 2013 through 16, I have not seen that yet. Now, it's going to be key when the 10K for 2017 comes out that I look at that. I look at it carefully to see if in 2017 there has not been a spike in accounts receivable. But based on these trends so far, I'm predicting that that probably will not be the case. So very important metric. Another one, inventory. Again, inventory is portrayed as an asset. But is it really an asset? Inventory. Inventory is not worth anything unless I can sell it. And so one of the classical warning signs at a dividend growth company is if one sees a spike in inventory. And one oftentimes sees a spike in inventory when sales growth is sluggish or down because there's less sales. The company produced all this inventory and they can't sell it, but so they portray it as an asset on the balance sheet. Again, Kimberly-Clark passes the test with flying colors. End of 2016, inventory is $1.679 billion. End of 2013, it's $2.233 billion. Inventories are down. They're managing their inventory well. They're in a position where it's more of a made-to-order business. They're producing the inventory in real time. They're not stockpiling inventory. They're making good use of their funds, their resources. I love to see this. This is some of the metrics actually that give me the most confidence in Kimberly-Clark, despite the sluggish sales growth, that look, they are long-term oriented. They are managing their accounts receivable and their inventory really well. And I commend management for doing that. Now again, 10K for 2017, I'll want to look if there are any spikes in inventory, but if this example from the past 13 through 16 is representative, I imagine it will not. So I don't really look at other assets in the assets section of the balance sheet in much detail because quite frankly, these are the ones that matter to me as current assets. Again, if the company had a huge problem, they needed to raise money right away, quite frankly, what it comes down into is cash. Accounts receivable, inventory, they matter too, but those need to be discounted in that equation just because in a bad situation, could the company liquidate the inventory maybe for half price, maybe for a lower price? Could the company get all of their outstanding accounts receivable? Maybe some of them, but not all of them. So again, something worth looking at or worth keeping in mind. But again, looking at all of this, boy, they've managed it really, really well. So moving down the balance sheet, what comes next are liabilities. And there are two types of liabilities, short-term and long-term. I look at both of them. So short-term, typically you're looking at like a line of credit with a bank. You're also looking at accounts payable. For example, Kimberly-Clark may have partnerships with other companies who do stuff for them, like maybe a marketing agency or distributed sales team, or maybe they have to pay rent on office space. These accounts payable show up under liabilities, and so it's worth noting both that and also lines of credit and other things in short-term liabilities. So really what I'm looking for in short-term liabilities is very similar. I don't want to see any weird, crazy spikes or changes. And so I looked at the short-term debt. It did spike. It did spike in 2014. So 2013, it was $375 million. 2014, it went to $1.326 billion. And since then, it's been pretty flat. It actually come down a little. It went up more in 2015. 2016, we're down to $1.133 billion. Being a company with a market cap of $41.9 billion, having a short-term debt in the 1.1 billion range, that's very well managed. So whereas there was a spike in 2014 and 15, it's still so low that I don't see that as a red flag. It's just something worth noting. I don't have a problem with that. Accounts payable, I like this. Again, I like a company that pays its bills on time. A company that pays its bills on time is a good partner. A company that pays its bills on time respects everyone out there. Kimberly-Clark's accounts payable, they've been pretty flat through 2013 through 2016. 2013, it was $2.598 billion. 2016, $2.609 billion. Pretty flat. So basically, short-term liabilities, my checks there all look good. Again, I need to look at 2017 when it comes out, but I'm great with this so far. What else? So long-term debt. Let's look at that. Long-term debt is a very important thing to look at. What a lot of companies, dividend companies, are doing in the market these days is they are issuing long-term debt, aka bonds. They are doing this to basically, because interest rates are really low, and they're using it as a form of financial engineering to buy back shares of stock or to pay higher dividends. It's not sustainable in my opinion, because one day, maybe it's a long time from now, but interest rates will go back up. These bonds will have to be refinanced. I don't like long-term debt. It varies very much by industry. For a company like Kimberly-Clark, consumer non-cyclical, I like to see really low long-term debt. For other industries like utilities or real estate investment trusts, things are very different. It's a completely different industry. Long-term debt, high amounts of long-term debt are characteristic of those industries. And so it's really industry by industry. But in general, portfolio-wide, I skew towards industries with lower long-term debt. Technology industry, well, it carries many risks, typically has lower amounts of long-term debt. So something that's a pro of the tech industry. So anyways, long-term debt, it's steadily up. It went from $5.386 billion in 2013 to $6.439 billion in 2016. Slowly climbing, but that's quite low. Put another way, I look at long-term debt as a percentage of the market cap. So market cap 41.9 some odd billion. Basically, long-term debt is about 15% of the market cap. In my opinion, I'm okay with companies typically below 30%. When it's down at 15%, it's world-class. That's why Kimberly-Clark for me is a core holding. I love Kimberly-Clark. That's why I'm averaging in. They manage their long-term debt really, really well. They haven't been taking advantage of the low interest rates in a bad way, meaning taking advantage to do financial engineering. They're doing all the right things. I like that. So they passed the test. Next on the balance sheet is something called Stockholders Equity. For dividend-paying stocks, I don't put a ton of weight in this basket, but basically what stockholders' equity is it's whatever's left over. It's basically the assets minus the liabilities. And it's also known as the book value. If the company just completely were wiped out and they have these assets, they pay off all these liabilities, what's left and can be distributed. Another way of looking at it is it's retained earnings. It's when the company earns a lot of money. It stacks up over the years. It's what's retained and not paid out either as liabilities or as dividends. And so it's retained earnings. Stockholders' equity, the challenge with stockholders' equity for a dividend investor is most dividend companies, like they're very stable like Kimberly-Clark, they pay out dividends. They increase them over time. This makes the stockholders' equity, for example, if they did pay no dividend, it would be higher. And oftentimes it would be growing because it's retained. They're retaining the earnings. But a dividend company, by definition, they're not retaining as much earnings. They're paying it out as dividends. And so for me, I don't put a ton of weight on stockholders' equity, but I do like to see it pretty consistent, if not growing. And with Kimberly-Clark, it's actually gone down. In 2013, it was $5.1 billion. It dropped in 2014 to about $1 billion. And then in 2015-16, it's been lower. So 2016, we're looking $117 million. So the way I look at this is revenue's slowing, margins are expanding, dividends are being increased. Some of that may be eating into retained earnings. Some of the dividend increases may be eating into retained earnings. And so just something worth looking at. I don't put a ton of weight on it, but I imagine at the time that revenue starts growing again and they keep these great margins, they may retain more earnings. The rate at which revenue is growing and earnings are being generated may even outpace dividend growth. At that point, stockholders' equity will start growing again. I wouldn't say this is a red flag, but it is certainly something to look at. It's not a red flag because I don't place a lot of weight on it to begin with, but for dividend stocks. But again, something worth noting, and I'd say maybe a yellow flag. That's a good way of putting it. Something I definitely need to watch, and I'd like to see it grow again in the future. So to summarize, just going through everything here, we got the balance sheet. Key things worth looking at are the assets, liabilities, stockholders' equity. Within the assets portion of the balance sheet, I like what Kimberly-Clark is doing with cash. They're fine. I love green light on accounts receivable and inventory. Really well managed. On the debt side of things, short-term debt, it's fine. Accounts payable is fine. Everything looks good there. Long-term debt, really well managed, and so I'd say that's a green light. I would say going down to stockholders' equity, maybe it's a yellow flag, yellow light, maybe a little bit of a red light, not much though. So with any financial analysis, there's always going to be pros and cons. It's never going to be all green lights or red lights. Well, sometimes it might be all red lights, but even with the best of companies, it's rarely all green lights. And so at the end of the day, I'm happy with what I found here with Kimberly-Clark. On my to-do list, I just need to look forward to the next 10K in 2017 as well to make sure nothing has changed. I hope you enjoyed the video today. This is my third video in my series about analyzing dividend stocks. I hope you enjoyed it. Full disclosure, everyone, I own Kimberly-Clark in my stock portfolio. I am long on Kimberly-Clark. I've owned it for a very long time, and I've been averaging in recently as well. And so that's where I'm at with that stock. Also, as a disclaimer, I am not a licensed investment advisor. I'm not a financial advisor. Today's video is not financial advice. Today's video is just for your fun and entertainment. If you are going to go out and invest money in the stock market or anywhere else, please do consult a licensed financial advisor first. If you enjoyed the video today, please give me a thumbs up, a subscription, comments. They mean the world to me. The comments on this channel fuel the ideas for videos. I realize today's video is a little more technical than the others, so if you've made it this far, I really thank you. I commend you for hanging in there. This technical stuff, in my opinion, is what separates the great investors from the good ones. It's the numbers, it's the technical side that makes all the difference in the world in achieving superior results, market-beating results in one's dividend stock portfolio. My name is Ian Lopuck. I will see you in the next PPC Ian Dividend Investing video.